Welcome to Night Markets. Each week, I'll be giving you my perspective on what's happening in markets, as well as my point of view as a family office professional. My name is Jacobus Brink, the Chief Investment Officer and Head of Investment Research for South Africa at SFO. This week, the major indices experienced quite a significant divergence as we saw the Dow Jones Industrial Average actually post its largest weekly decline since early April. This was despite the fact that the Nasdaq Composite continued its very impressive rally to reach all-time highs. The S&P, on the other hand, remained fairly flat for the week. However, if you look at a equal weighted version of this index, it was actually down by 1.27%. But before we get into the markets, let's have a look at what the current situation in the Middle East, which has a particular impact on the oil price. So over the weekend, we saw some ongoing fighting in various parts of Gaza, including areas that Israel had actually previously claimed to have under control. On Saturday, we saw protesters engage in confrontations with police in Tel Aviv after a day of demonstrations demanding cessation of hostilities and the safe release of hostages. However, in some good news, an Egyptian official did indicate that negotiations between Israel and Hamas for a ceasefire and a hostage swap deal are actually set to resume on Tuesday. These recent developments did, however, put a little bit of pressure on the oil price after we saw it pull back quite significantly over the past week. So moving back to the markets, let's start with the US. And big news out was definitely the release of the NVIDIA earnings. Once again, blowout earnings, and it actually has now become the third largest company in the S&P 500 by market capitalization, trailing Apple and Microsoft. So following an already impressive performance this year, NVIDIA shares actually experienced a significant increase of 9.3% on Thursday. This resulted in an addition of approximately $220 billion to the market cap. NVIDIA has contributed significantly to the S&P 500 earnings per share gains that we've seen over the past year. Looking at some macroeconomic data, the composite index of business activity in the US surged to 54.4 in May. This is the highest level that we've seen in 2 years, according to the S&P Global Report. This is despite the fact that markets were expecting economic activity to actually start to slow down in the US. And although there was a slight increase in manufacturing activity, the services sector actually experienced a more significant acceleration. And the problem is the inflation data in this report seem to be of particular concern to investors, as the selling price inflation has now actually increased and is trending slightly higher than the target inflation. And in this case, what is worth noting is that the primary driver of inflation currently is actually the manufacturing sector rather than the services sector. And as a result, both costs and selling pressures are experiencing a moderate increase. So just looking at the market performances, as previously indicated, the positive outcome for NVIDIA did not result in wider gains as the Dow Jones Industrial Average fell by 2.77%. This is despite the fact that the Nasdaq actually gained 1.37%. And because of the surprise in upside inflation pressures, the benchmark 10-year US Treasury note actually ended the week significantly higher, with the market now expecting a higher for longer position from the Fed. And then moving across the pond to the Eurozone and the UK, we saw some initial estimates from the Eurozone for the Composite Purchasing Managers Index. For May, it actually reached a 12-month high of 52.3, showing quite an improvement from April's number. The services sector, however, continued to show very strong growth, while the manufacturing side of the PMI also showed an improvement, but it remained in contractionary territory for the 14th straight month. Input costs and output prices also decreased, which is obviously a good thing for inflation, but they still remain higher than they were pre-pandemic. Additionally, ECB President Christine Lagarde also conducted an interview, and she still expressed confidence that the central bank's plan to potentially lower rates in June is on track. Inflation news out of the UK was actually less positive. We did see quite a significant slowdown, but it was less than anticipated. The inflation numbers dropped to 2.3% in April, which is the lowest level we've seen in nearly 3 years, from 3.2% in March. The fact that these numbers did, however, come out not as slow as expected did damp the expectations for the reduction in borrowing costs by the Bank of England. And the consensus is now actually estimating that headline inflation will be at 2.1% for the year. So post the release of this data, the markets are now actually pricing in a single quarter point rate cut for the year rather than two, which is obviously not great for the consumer. So just looking at the market performance, based on the strong PMI data we saw out of Europe, the Pan-European Stocks Europe 600 index actually gained 3.01%, with Germany leading the pack there with an increase of 4.28%. So moving across to the Far East, Japanese equities ended the week lower as the Nikkei 225 dropped by 0.36% and the Topix index also saw a slight decrease. Positive economic data releases provided support for equities during the week. We actually saw Japanese manufacturing activity experience a recovery in May. This marked the first expansion in over a year. Unfortunately, all of those gains were lost on Friday as Japanese indices also followed the downward trend in Wall Street due to the US data that pushed the possibility of a US interest rate cut further out into the future. It was a significant week for the Japanese bond market as for the first time in 11 years, the 10-year government bond yield actually reached the 1% level. This was mostly driven by speculation about the timing of the next move by the Japanese central bank, as well as a possible reduction in the government's bond purchasing program. Chinese stocks also declined due to concerns around the trajectory of US interest rates, overshadowing the positive outlook on Beijing's recent effort to support the struggling property sector. Although the majority of investors did seem optimistic about the recent plan, there were still those who have doubts about the ability to actually resolve the ongoing property slump. This continued to weigh heavily on the world's second largest economy's indices. And then bring it back home as South Africa prepares for the elections on the 29th of May. Africa's largest economy got some good news for a change this week as the inflation rate dropped for the second month in a row due to a more moderate increase in food prices. Consumer prices increased by 5.2% in April compared to the previous year. This was slightly lower than the 5.3% increase in the previous month. The data is, however, unlikely to sway monetary policy makers who are set to meet next week. Regarding the benchmark rate, which has remained at a 15-year high of 8.25%. The central bank governor has consistently emphasized the importance of waiting for inflation to decrease to the midpoint of the target 3 to 6% range before making any adjustments to policies. Over the past month, the rand has experienced a 5.6% gain against the US dollar due to the anticipation that the ruling ANC may not have to form a coalition with a left-leaning party in the event of losing parliamentary majority. According to most opinion polls, it appears that the support for the ANC will, however, fall below 50% for the first time since it gained power in the country's inaugural multiracial vote in 1994. So, barring any major surprises on Wednesday, the fact that we have seen a strengthening in the rand with a downward trend in the latest CPI numbers, this should bode well for future CPI prints. So, just looking at the market performances, the all-share index ended the week lower by 0.5%, mostly driven by the resources sector, which dropped more than 1.5% on the back of some weaker commodity prices. As mentioned, the rand had another strong week, trading as low as 18.07 to the US dollar. Only to end the week lower at 18.44 due to some risk-off behavior on Friday. And then just looking at the week ahead, it is a holiday-shortened one due to the US markets being closed on Monday, celebrating Memorial Day, as well as the local markets on Wednesday closed for the elections. From a macroeconomic point of view, the focus this week will be on inflation numbers out in the US, Australia, and the Eurozone. These will obviously be key in driving the way the markets see the outlook for interest rates going forward. The markets will also be keeping a close eye on the consumer confidence numbers out in the US on Tuesday, just to give us an idea of how strong or weak the US consumer currently is. And locally, other than the eagerly anticipated outcome of the elections, the market will also focus on the South African Reserve Bank rate decision on Thursday. Given that the market is widely expecting the Monetary Policy Committee to actually keep the repo rate unchanged, most of the focus will be on the governor's post-MPC press conference. And then, as always, an interesting investment idea we would discuss during the week. It might not be a new one, but I think it continues to be an interesting one for investors. With the market now expecting rates to remain higher for longer in the US, we think it's not a bad idea to still actually look at buying US Treasuries. The 1-year Treasuries are currently yielding in excess of 5%, which, if you think about it, earning 5% in US dollars is not a bad one. So thank you very much for joining me once again for another episode of Night Markets. Financial markets close at 5 p.m. Night markets open at 6 p.m. Let's start the conversation.